All right. Well, good morning, everyone. My name is Alan Richardson. I'm the managing broker at Maximum Realty and Realtor Partners. This is my lovely wife and partner.
My name is Ming Richardson. I'm the compliance broker for Maximum One Realty and Realtor Partner. Welcome Monday.
And this is our weekly real estate backstory. We do this every Monday morning. Now we're starting a couple minutes early this week, but still we do it every single week. We try and expose the soft underbelly of the real estate world kind of thing. So we kind of wanted to jump in this week and talk about something that we have a lot of folks joining into real estate, a lot of new people coming in, and a lot of times there's just a lot of activity going on, buyers, sellers, interest rates rising. We'll talk about all that, but like some of the core fundamentals is that, as a realtor, as a professional realtor, real estate agent, you really need to have very strong vendor relationships. I think there's a lot of agents that I'm not going to say neglect it, but they neglect to build those relationships. And they are very important. One is that if you have strong relationships, when you need someone, you already know who to go to for that. And they already have a relationship with you. The other thing is that you don't want to have to go out and find somebody that's going to take care of one of your clients, and then at that point you're kind of asking, and you don't really have any kind of relationship already set up. And so that's a really important thing, because a lot of times with our clients, it's not just us. We come and even if you're a solo agent or on a team, a lot of teams have these things set up, but as a solo agent, you really are a team as well, kind of thing.
Whether or not you're solo or with a team member, it's good to be able to say, hey, this is a vendor I trust. Hey, this is a handyman I trust. Hey, this is the inspector I trust, and what have you. Because with that relationship, you can give them a call 9 out of 10 and ask for explanation. 9 out of 10, they will answer your question if they don't know it. And not only that, they also will see if they can alter their schedule to accommodate yours. Mm-hmm. So the relationship power is like referral. The more you have, the better you are.
Well, and a lot of agents start off and they have that one lender relationship. And we recommend that you need to have a couple of very strong lenders on your team out there that is ready to take care of your clients, and they're going to answer their phone, and they really do a good job on there. But it's more than just them. You also need a closing attorney. Now, if you don't have lenders and attorneys, feel free to use your brokerage's relationships already. Like for us, no one's required to use our vendors necessarily, but leverage the relationships we already have. If you don't have
leverage,
those,
is not necessarily using or anything like that. It's a symbiotic relationship. Honestly, they take care of you and you take care of them.
But a lot of times your brokers will have those kind of relationships where if you call a closing attorney, they're going to pick up the phone, they're going to answer your questions, that kind of stuff. But it's not just lenders and closing attorneys. You need everything for home services.
Plumber, HVAC.
All your inspectors is another one that's really good. Of course, everyone for the home, contractors, that kind of stuff, but even
surveyor, come on.
Well, what about those folks who aren't necessarily related to the transaction? Like because a lot of times you have folks moving in from out of town.
Moving company,
doctors, there's a lot of things that go in that. And see, the other thing that really comes out of this is when you start becoming a referral source, you start becoming a referral source. I know I'm using the same term, but what I mean is it's a referral world. 80% of realtors' business comes from people they know and people that know them. And so the more relationship you have with more vendors, the better off you're going to be. When you give more referrals, you get more referrals.
Absolutely.
All right. So I'm just going to get off my soapbox for a little bit, kind of thing. We kind of wanted to kind of jump into kind of what's going on in the real estate world. So first off, a new report came out talking about the strength of the fourth quarter of last year. Overall, GDP came in at 6.9% for the fourth quarter of 2021, and that is massive kind of thing on GDP growth. Now, the thing that comes with that is that GDP growth is one of those things that shows our economy is really, really strong.
It's an indicator of what our economy is doing.
And so, that's one of those things that really kind of is leading into what we're seeing in the mortgage rates and what's going on in interest rates. So this past week, the Fed met for Tuesday and Wednesday this past week, and we already know that they're tapering bond purchases, and we'll talk a little bit more about that. But they're also going to be raising the fund rate. We're going to be talking about that. And so, we're seeing where, we've gone through 5 weeks of mortgage rate level increases kind of thing. And so it kind of flattened this week at a 3.55. And so that's not necessarily a terrible thing. I'm kind of glad to see it's in there. I really feel that we're going to be closer to 4 by the end of the year. But, as this moves forward, that's going to continue to have a lot of impact on our buyers. And so we need to make sure that our buyers are ready and they kind of understand what's going on. But this has also kind of led to a lot of buyers that are really trying to get into the market because, for months we've been saying interest rates are rising. It's a good time to buy. You want to get in before it goes up.
Lock it in.
And now we really are seeing that going on. But one of those other things out there is are your clients mortgage ready kind of thing? And a lot of agents still don't really understand and what it takes to be mortgage ready. So first of all, you got to have a credit score. And realistically, you need a credit score of 660 or higher is really what you need, 661 plus. You also need to have a debt to income ratio, DTI, of 25% or less. So you want to have less than 25% of your debt based on to your income.
When they say that, it doesn't calculate the current rent you're paying. So don't think that, because what lender looks at is your overall expenses for the month. So what they're looking at is higher rate, but on this graph, it shows your debt to income ratio based on your normal item other than your mortgage or rent.
And then no foreclosures for the past 84 months. And then no severe delinquencies. Harder to say than apparently I can do.
12 months.
Yep. And so, how are we looking? And here's something that's really pretty interesting is if you look at which generation is the most mortgage ready, Generation Z, which is our youngest buyers out there, are the largest group by generation that is mortgage ready. Now, in contrast, our younger millennials, they're doing better and that kind of stuff. But still, I just found it very interesting that the most mortgage ready generation out there is Generation Z, and they are our youngest buyers. They're not even at first time buyer age kind of thing. So over half of them who are in the market are now mortgage ready. And so that's a really good thing because you can understand that the share of young adults that have been living at home has been increasing for years. And it's really kind of,
and they're ready to move out.
So, right now about 17% of young adults are living at home. And one of the big reasons why they're living at home is
inventory.
Yeah. I mean, we're really, really tight on inventory. We know that's the issue. But when folks are saying, well, why is the housing market? Is the housing market going to crash? Things like that. I mean, this shows the amount of pent up demand for housing in our market right now. So now the Fed is talking about raising the effective rate or the federal funding rate.
What that means is that typically how bank accumulate their ability to lend out money is they borrow from the Fed. So for a very long time, Fed, you can see beginning of 2020 have zero interest rate, nearly zero interest rate for the bank to borrow the money. And now they're looking at raising that rate because it's time.
Yeah, and they're talking about 6 raises this year. And I think 6 is probably going to be about the right number. I wouldn't be surprised and they're talking about March being the first one, and I wouldn't be surprised if they raised it a 0.5 point. Normally they raise it by 1/4 point or 1/8, but it really would not surprise me if they went up with a whole, because right now, when you look at what GDP is doing, and then the inflation is, inflation is the new 4-letter word, and that's a big deal out there in the marketplace. And so I know that they want to shock it, but they don't want to cause the same recession that we had in the 1980s.
At some point,
from that.
the federal has to go back
Yep.
up a little bit, and this is where you see that, where right now the interest rate is still 3.5. That's because there's no cost to the bank to borrow money from the federal government. So therefore, when the federal government is still raising the rate, you'll see the mortgage company raise their rate as well.
Now, when the Fed raises their funding rate, is that going to raise interest rates? Yes and no. And what we mean by that is so when inflation is high, investors tend to sell off treasuries, and mortgages follow the 10-year treasury note. Now, when they sell off treasuries, they have to raise the cost of the treasury notes, the 10-year treasury, and that makes those rates go up. When those rates go up, mortgages goes up. So, we follow that 10-year treasury. The Fed stopped buying treasury notes, which they started at the beginning of the pandemic and that kind of stuff. Now, for other types of loans, like home equity loans, credit cards, any kind of interest-bearing debt, those are going to move up by the same percentage that the Fed rate kind of goes up.
Right.
As far as car loans are actually market driven. They're already not really low, stupid low, some of them kind of thing. But the bottom line on car loans is that there's a huge demand on cars already. But there's competition on car loans. So that tends to really drive the rates there much more so than the federal funding rate, because those rates are higher anyway. So what happens when we continue to see these kind of rates? Well, so we just spiked for the most in, mortgage rates jumped up more than the past 9 years kind of thing.
Okay, when a headline like this, you gotta be careful, because when they spike, meaning spike from what it was, not necessarily the overall total interest rate.
But if you look at December 31st to January 31st, that jump, that is the most in 9 years. Now, historically, mortgage rates are still really, really low. The whole bottom line here is we don't see that. I just broke my own rule there. But we don't see that property values are going to be dropping kind of thing. We do feel that price growth is going to slow.
It's flattening out a little bit.
Right. And so, right now, Fannie says it's going to raise, prices will jump by 7.9%. Redfin saying 3%, and Mortgage Bankers Association, the MBA, is saying it's going to drop 2.5%. We think it's going to be in that 3% range, 3 to 5%. And that's going to be a big shock to a lot of people. We have to make sure that we are getting them ready for what's going on. Sellers, we need to know that we're not going to keep going in this. I mean, we've kind of been doing this hockey stick property appreciation. That's going to level off and be much more modest. We're not going to see price drops, but the idea of just throwing it out there at ridiculously high values is going to be, we're going to have a lot more pressure on price than we've had in the past. It's still going to be a seller's market. Don't want to take anything that away. But I mean, because you can see what we've been running. So, we pulled up the newest numbers for for last 4 weeks. And so you can see that, our median sales price is 14.4% year over year. And you can see where it was in 2020 versus 2021. And so we jumped up another 14%. We really think that this number is really going to start fluctuating off much more closer to last year as the year goes on, because most of these numbers happen while those interest rates and most of your real estate numbers tend to follow, a month to 2 to 3 months behind, when actual events happen. So, pending sales is 2020 was up over 2019, 2021 was up. And so we're trending in there, but this we feel is much more of an inventory issue than it is a demand issue kind of thing. One thing I do see with the mortgage rates coming on and that kind of stuff, I think we're going to see a lot more pressure still on, I guess you call it value price starter homes. Anything under 250 basically is going to still continue to have a lot of pressure on it. New listings on the homes, this is what we were talking about. That's down 12.5%. And so you can see that, we're down under 2020 and under 2021. Overall, we're down about 30% year over year, January.
Or active listings.
Yeah, for total number of listings. And so, it's going to take a while before we get back up to that level here. And so, we do see that this is going to start trending, I guess you'd say, much closer to flat here.
Correct.
Even in everything going on, still about half of 45% of our pending sales are under contract within 2 weeks.
So if you price your property correctly, it should not be on inventory in 1-2 weeks.
Yeah, that should be kind of like your benchmark. Like if you don't have, if you're not under contract in 2
yes,
weeks.
we have seller that
Yeah.
demands a certain price point, and this is where you can benchmark it and let them know historically, statistically, right now, it should not be more than 2 weeks.
Yeah. Right now, the average home is selling at 100.2. So basically, we're at list price. And so, and I'll show you a graph here in a minute. It shows how both boomers and millennials are looking at making offers on properties. So, single ladies, hey ladies. Hey ladies, single women, skip the spouse, buy the house. More and more women are looking at buying homes before they get married. In the past, it's kind of been, I don't know if it's old fashioned or what, but it was get married, then buy a house. But more and more single ladies.
Well, you see more ladies are more professional in the fields now, and they're concentrating on their career first.
Yep.
So
women save more money than men do. Single women save more money. Single women are better focused. You guys are just better than us, basically. So, but I do feel that is a fairly untapped area. Well, I don't see a lot of agents that focus on single ladies and unmarried people kind of thing. And I do feel that that's a pretty significant buyer segment out there, because honestly, a new study came out and said 40% of Americans are considering a move in 2022. Almost half, 40% of the United States is a massive number kind of thing. Nearly half of those, 46% of people that are considering a move are wanting to buy a home. Now they have the desire to buy a home kind of thing. Now, the most likely is Gen Z and millennials. Remote workers for sure. And I do feel that folks that are remote workers are a great target market as well. So like single ladies that remote work, are you following me here? Parents with young children is another one kind of thing. And still the number one reason, and this has been ever since the pandemic, is
more space.
Yeah. They want more room kind of thing. The other one is animals. Animals is a really big deal. Having dogs, pet friendly at 54% is the number one consideration for having a a must have for your next home. And that's a big change. The shelters all ran out of dogs, that kind of stuff during the pandemic. Everybody needs their puppies, so we have them too. We understand. All right, millennials are willing to blow their budgets and buy sight unseen. Much more so than like our baby boomers kind of thing. Right. And so you can see in here, like 42% of our boomers are willing to go at asking price. And we're seeing a lot of that going on right now. I have to straighten out my tie, sorry. But our millennials, like 17% of millennials are willing to go 17% or up to $100,000 over asking.
Not crazy.
So I'm not promoting that kind of thing, but it just shows that our millennials are very, very eager to buy homes. Our boomers, everyone has got that expectation that, full price really is kind of where we need to be on a lot of these. It's going to come down to whether or not that price is really realistic on there. What would convince them to buy a home sight unseen? Number one, price. Also, new construction is another one that where buyers will buy sight unseen.
And anytime seller in today's market offer any concession, that is a huge one.
Yeah.
And also high competition from other buyers.
So those hot properties.
And I have agents call me in the past, say, how many offers do you have? I tell them.
Yeah, always. So when we say, why do you want to buy a home in the next 12 months? Overall, our millennials feel that it's a good investment, much more so than anybody else. Our boomers, the lower interest rates is definitely a driver for that. And we need to be talking about that, because one thing that we see is like, is it a good time to buy? Yes, it really is. If you're going to buy, now's the best time. Interest rates are only going up. Prices may come down into that 3 to 5%. I don't think they're going to come down. They're going to level off the rate of appreciation, but they're still going to go up. So you're going to end up spending more for your home. So now is the best time to buy, and at the same time, it's a great time to sell. So Now, on the front of good things that are happening out there, fewer and fewer buyers are now waiving contingencies.
Yay.
And we're really glad to see that. We feel that that's a very important.
I actually see more requests for repairs than I ever had before. And, agents, are you still doing zero due diligence? I would not encourage that at all because, clients will come back to you and say, you didn't protect me.
Yeah.
You're a professional in your field, but yet you told me to waive my due diligence because I can get inspection. So that's huge, y'all.
Yeah, we really need to be doing that. And so protect your clients. The average home seller in 2021 averaged $94,000 in equity. And so that's awesome. that really is good. So a lot of our home sellers are walking away with a lot of equity. Now, the challenge for our sellers is
find another one.
Yeah, exactly. You can't just be homeless out there, kind of thing. 2021 was also a record year for commercial sales. We generally find that commercial tends to lag behind residential by about a year. And so, even though residential was really on fire, commercial was really, really on fire. Mm-hmm. The other thing that I found very interesting was it wasn't on the commercial side, it wasn't just warehouses. Warehousing was very, very big, but the number one sector in commercial was multifamily.
Right.
And that just shows how much demand there is for overall for housing. We just don't have enough houses. We don't have enough rental homes. We don't have enough houses, period.
And that's kind of interesting. A lot of investors are picking up resorts, and that's because they're trying to buy low. And when the market's right, when people are going out to resorts, they're going to sell it.
Yeah. So, of course, this rental prices are soaring right now. They really are going through the roof, kind of thing. The rental vacancy rate fell to 5.8%, which is the lowest it's been since like 1980. So we're talking about the lowest rate in 40 years, kind of thing. Now, there is a ton of demand for low end rental. When I say low end, low price point rentals out there, kind of thing. In a
starter renter, I guess that'd be a good word for it.
There were 44 million renter households in the third quarter of 2021. That's an increase of about 870,000 people since the first quarter before the pandemic. So that's that whole thing. Like we've been making babies, we've been creating households and making people. Whole time we haven't been building nearly as much. Most renters would be a homeowner if they could win a bidding war. And so that, again, shows the strength out there. And then the other cool thing is that even through the whole pandemic, the vast majority of renters kept up with their payments, because we talked about earlier, what you have to have if you want to buy a home, you can't let your credit get jacked up. So even if you had the moratorium, it was still going to put a ding on your credit out there. Now, on the negative side, built to rent homes are expected to hit an all-time high in 2022, kind of thing.
They are investment apartment complexes and townhomes that are being built strictly for investors right now. And don't be surprised, because they're still good investment.
Well, and they're looking to build 14,000 more rental houses, kind of thing, new construction rental houses. And for me personally, I think this is a negative for our industry. Wealth in the United States is tied up in home ownership. And so if folks are going to rent, if you rented a year ago, how much equity do you have today?
No.
If you bought a year ago, the average equity in Georgia is $50,000. So, as a renter, in 1 year, you don't get that. And so even over long term, 3 to 5% is our average appreciation. And if you rent for 20 years at 5% appreciation, that's 100% right there, kind of thing. So that's a lot of money that where the investors are trying to take that wealth that would come from home ownership. So we want to really be promoting that out there. So HUD announced this $4 million for radon testing. And it really doesn't affect us that much out there. We don't see it very much. And this is really going to be something that goes out towards the public housing agencies out there. But one thing that we don't see is, we don't see a lot of radon tests. And I think that we will. Radon remediation is not really that difficult. There are a lot of areas in Georgia around Stone Mountain and things like that where radon levels are traditionally very high. I do think that we are going to start seeing more and more radon. And so I just kind of throw this out there just to say, look, that's one of those things that you really need to make sure is on your radar and you understand more about radon and what it is.
And
Now,
honestly, these are only applicable for the property that HUD managed. So these are only for their foreclosures, not to the public.
well, and it's also for the public housing agency. So again, it's not about HUD, it's about understanding radon and expecting to see radon more often out there, kind of
To
thing.
be a little more popular.
Yep. Now, code of ethics deadline was December 31st. And
If you didn't take it, guess what?
Yep, you are now listed on suspended status. We have sent that out to all of our agents. You have until March 1st, at which point you're getting the boot. So please don't dawdle anymore. We're going to go ahead and schedule another class in February. So if anybody has
Easy
to get
for
it
him
in
to
there,
say.
well, she teaches it. So yeah, it's way easier for me. And then, so this week we start I'm starting relaunch this week for training. Relaunch is our 25-hour post license. I do that once a quarter, once every 3 months.
And also it count, if you're not wanting to take that relaunch, each one of these classes will count as 3 separate CE hours.
Yep. So we have lead generation on today. On Wednesday, we have real estate marketing and technology secrets. And on Friday, we have business planning. And so all those can be separate CE classes that you take. They are all already sold out in person because they're all in person in McDonough. But we also have, because of the demand for these classes, we added them virtually so you can catch it online. I am going to be the one teaching that. So I hope you guys have a great week. If you need anything, please call, text, smoke signals. We answer it all.
We normally would do chat, but as you can see, our relaunch start here in a few minutes. So we will not be doing chat this morning.
Yep.
Thank you all very much and have a
Bye.
fabulous Monday.
Have a good one.
Bye-bye.